So welcome to the third video in my Cooking the Book series, where I take a look at ways that companies can try and pull the wool over your eyes as to exactly how much money they're making and how you can go about making sure you're not fooled as an investor. So this week, with no more ado, I want to jump in and have a look at the treatment of long-term business assets. Doesn't sound very exciting, but actually there's a really simple way in here for a finance director to slightly mislead you as to exactly what's going on. So let's take an example. Imagine I've spent £100,000 on a big asset, right? That's its cost. What I've got to do next under the accounting rules is decide how long I think it'll last and whether it'll be worth anything at the end of its useful life. And that's because accountants will look at something like a big asset worth £100,000 and they say, what are we going to do with that cost? Because this is an asset that's potentially going to generate revenue over, say, the next 10 years. So if you just dump all that cost in profit immediately, you'll see the whole £100,000 annihilate profits for this year, and then there'll be no charge for all the benefit that asset brings to the business over the next 9 or 10 years. All right, so that doesn't sound very good. And equally, if you were to simply say, well, I'll wait until I finish using the asset and then book the cost against profits, that would look a bit weird too. Then you'd have a hit at the other end and nothing in the middle. So what accountants try and do is they say, well, what you want to do is spread the cost of the asset over its useful life. And that way, as it brings in revenue, this piece of plant, machinery, whatever it happens to be, you'll be sort of matching up the revenue it generates with the cost of acquiring it. Okay? And the technical term for that, by the way, is depreciation or amortization. Now, so far, so what? Well, here's the point. You've bought this asset for £100,000. Who decides how long it's going to last and what it'll be worth when you sell it? Because that influences the charge that's shown against profits each year. Okay? Now, I'll show you what I mean and how much flexibility there could be here to massage the profit figures, even on a relatively simple one-off asset. So let's take a look at what the finance director could do here, making 3 different assumptions. 1, that £100,000 asset will last 10 years. 2, it'll only last 5 years before it's sold. And 3, it might last 20 years. Okay, so quite radically different assumptions about how long the asset's going to be of use to the business. And see what that does to the amount that's charged in the profit and loss account. Okay, so here's my scenario. Okay, we're going to say the asset cost £100,000. I'm going to make the numbers really sort of round and easy. Okay. How long it lasts is the key decision, something the directors decide, but we'll start with 10 years. All right, and we'll assume that after 5 years, it's sold for £50,000, 50k. Okay, so if you like, at the start of year 6, we dump it for £50,000. Now, here's the point. Let's assume we're going to take a few years here. So we'll take 1, 2, 3, 4, 5 years, and then we get the sale. All right, so I'll look at the profit on sale in the last column, okay, based on the fact it sold for £50,000. Let's see what happens if the finance director is able to persuade investors and the auditors that the appropriate useful life for the asset is 10 years. Because don't forget, when you buy an asset, it may not be clear exactly how long you're going to use it in the business. Okay, this is kind of telling you with the benefit of hindsight that it was sold at the start of year 6 for £50,000. All right, so let's assume you set off saying, well, the asset will last 10 years. All right, when you buy it, you think 10 years. So the charge against profits is going to be based on a useful life of 10 years. What does that mean? It means what the accountants will do is they won't dump all of the cost of the asset in year 1 against profits. They'll say, well, £100,000 spread over 10 years is a charge every year, simple maths, of £10,000. And on that basis, if the asset did last for 10 years, we kept it for 10 years, we'll have charged the full £100,000 across 10 profit and loss accounts, okay, and then we presume you need to buy a new asset or something. So here's what the profit and loss account, roughly speaking, would look like. You'd have a charge of 10k in year 1, 10k in year 2, 10k in year 3, I know the numbers are a bit scribbled, but you get the principle, very straightforward numbers here. 10k in year 4, 10k in year 5, and then, oh, wait a minute, we're selling the asset for £50,000. Well, the question is, in the books, if I've written off half of its costs so far, probably see where this is going, in the books, the asset is now only sitting at 100,000 minus 10, 10, 10, 10, 10. So its net book value, if you like, is £50,000 because I've written £50,000 off already against profits. If I sell something for 50 that's in the books at 50, my profit on sale is nil. So you might say, so what? So the profit and loss account shows £10,000 charged against profits. Okay, I then sell it for £50,000. It's only worth £50,000 in my books after 5 years, so profit on sale, 0. 50 minus 50. But here's the point. What if, at the beginning, the finance director said, I don't expect the asset to be used in my business for 10 years, I expect it to be used for 5. Well, if your expectation is the asset's only going to be used for 5 years, you would write the original cost off against profits in a sort of 5-year chunks. And that would mean your depreciation expense, as it's called, isn't 10k per annum. Based on a life of 5 years, 100,000 over 5, it's 20k per annum. Now let's just see what happens with the same scenario, but charging depreciation at double the rate. So now, I assume a life of 5 years, I write off 20k there, 20k there, again I'm scribbling a bit, but you get the idea, 20k there, 20k there, and £20,000 there. Now, that means by the time I get to the sale, I've written off the whole £100,000 against profits already, 5 lots of £20,000, which means if I manage to sell the asset for £50,000, that's a straight profit, okay? Because £50,000 minus the book value of the asset in the account, which is 0, is £50,000. Now you might be saying, well, this is all very interesting, lots of numbers, what's your point? Well, the point is, the profit profile looks rather different in this scenario. The profit and loss account's been hit 5 times for 20k and there's only boof, a profit, which is rather different to the first scenario. We are hitting it with 10k at a time and then showing no profit at the end. Okay? As a shareholder, that gives you a rather different profit profile. And let's do a third example. I won't get too carried away, let's make it extreme. Let's say the initial assumption was that the asset would last 20 years. Who makes this assumption? Well, the directors do. It's their asset. They sit down and go, well, the accountants want me to estimate a useful life of the asset, so let's say 20 years. How would that look? Well, now, you'd be only writing off 1/20th of £100,000 every year against profits, because that's your stated depreciation policy, to use the accounting jargon. But we're going to still assume you managed to sell it for £50,000 after 5 years. How will that look? Okay. Well, the answer is now you'll have written off £5,000 every year as a charge against profits. Okay. So your profit loss account's only being hit quite slowly each year for £5,000 at a time. £100,000 over 20 this time. So what happens if you then manage to sell the asset, okay, after 5 years for £50,000? Well, the answer is this. The asset will be in your books at £100,000 minus 5 lots of 5. So that's £25,000 written off. So it'll be in the books at £75,000 book value, if you like. And you're selling it for only 50. Well, you've sold something for 50 that's in your books at 75. You've taken an overall loss of 25k. All right, and here's the point. That looks rather different to either this profile or this profile, because assuming 10 years at the start, you write off £10,000 a year, show no profit. Assuming a 5-year life at the start, you write off £20,000 a year to give you a 50k profit at the end. And if you assume a 20-year life, then you only write off £5,000 a year while you're using the asset, but selling it for £50,000 actually generates an overall loss. Okay? And you might be thinking, well, isn't this just a lot of messing around with book numbers and accounts? The answer is yes, it is, but it will change what the profit and loss account looks like. Now, I've made it a bit extreme. Perhaps in reality, yeah, the directors wouldn't be able to argue that you could possibly have an asset where the useful life is 10 years, 5 years, or 20 years. Okay, but I have exaggerated to make the point slightly, but the point is nonetheless valid, that the directors decide, number one, how long an asset's going to last, and that dictates the hit they take for profits against profits, known as depreciation, or in the States, amortization, okay? And secondly, knowing what the asset's actually going to be worth when you sell it is more art than science, because no one can predict the future, but that also influences the number that ends up here when you compare what you sold it for to what it was sitting in your books at, and the overall profit on sale reported in that profit and loss account. Okay, so lots of scope for playing around. Solutions. If you're thinking, oh, crikey, I can see how this could really mess up the profit and loss account. Solutions. There are a couple. Some analysts like to use numbers, profit figures that exclude all this messing about. There's a profit number out there, which I deal with in another video, called What is EV/EBITDA. There's a profit number out there called EBITDA, earnings before interest, tax, depreciation and amortization. Earnings before depreciation and amortization. In other words, earnings before all this faffing about. And some commentators will use EBITDA for that very reason. I'm not going to cover it here because, as I say, there is a video, What is EV/EBITDA, out there already. Another solution, forget profits altogether. Some people say, don't trust the profit and loss account. There's these funny things going on in there that change the profit figure overall. So another solution is to turn to cash flow. Okay? In particular, free cash flow. And in a video called The Number the Directors Don't Want You to Know About, I talk about free cash flow and why that can be a more reliable guide to what's going on than pure profits. Okay? But the message from this video is that in a very simple but very important part of the accounts, the way you deal with your long-term fixed assets, your plant, machinery and so on, that can have quite a significant overall effect on profits, and it's something that as an investor I'd urge you to keep a watchful eye on.